Ryan bought gold the day Alex bought his first stock. Same day, same amount, $50,000 each. For the first 2 years, Ryan sent Alex a meme every single month. A gold bar emoji, a rocket. Sometimes just the words, "Told you so." Then something happened that neither of them expected. And by year 20, one of them had over $350,000 more than the other. No real estate, no leverage, no rental income. Just two guys, same money, different bets. Dollar for dollar. Let's run it. Ryan and Alex are 30 years old. Same city, same salary, $60,000 a year. Both just got a $50,000 inheritance. Same starting line. No excuses. Ryan is old school. He doesn't trust the stock market. He watched his dad lose money in 2008 and swore he'd never touch Wall Street. Gold makes sense to him. It's real. You can hold it. No CEO can lie about it. No earnings report can crash it overnight. He buys $50,000 in gold, physical bars stored in a vault, and sleeps like a baby. Alex is different. He's read the data. He knows Warren Buffett's favorite holding period is forever. He puts his $50,000 into a simple S&P 500 index fund and sets up automatic reinvestment. No stock picking, no trading, just the market, doing what it does. Two guys, two bets, one winner. But the winner isn't who you think, at least not yet. The first 3 years are Ryan's years. Inflation is spiking. The Fed is raising interest rates. The news is chaos. Bank collapses, recession fears, geopolitical tension. And gold does exactly what gold is supposed to do in chaos. It surges. Ryan's $50,000 becomes $63,000 in year 1 alone. A 26% gain. He didn't research a single company. He didn't read one earnings report. He just sat there, and his gold went up. Alex? His S&P 500 index fund is down 18% that year. His $50,000 is now $41,000 on paper. He's not selling. He knows the data, but it doesn't feel good. Ryan's memes are getting harder to ignore. Bro, gold. I'm just saying. It's a long game, Ryan. And here's the thing. Ryan isn't wrong. Gold's recent run has been historic. From 2018 to 2024, gold went from around $1,200 an ounce to over $2,600. That's more than double. Anyone who bought gold in that window made serious money. But Ryan made one mistake that he doesn't even know about yet. He's measuring the wrong thing. Here's what gold actually is. Gold is a rock. A beautiful, dense, historically significant rock. But it doesn't build anything. It doesn't hire anyone. It doesn't create a product, serve a customer, or generate a single dollar of profit on its own. The only way Ryan makes money is if someone else is willing to pay more for his rock tomorrow than he paid today. That's it. There's no engine underneath. No compounding, no dividends, no yield. Just price. Just sentiment. Just whatever the world feels about gold at any given moment. And here's what that looks like over the long run. From 1980 to 2000, 20 full years, gold lost value in real terms. Not underperformed, lost. If you bought gold at its 1980 peak, you didn't break even until 2008. That's 28 years of holding an asset that earned you nothing and grew you nothing. Ryan didn't buy in 1980, but he bought near an all-time high. And historically, that's the most dangerous entry point for gold. There's also the tax problem Ryan hasn't Googled yet. The IRS classifies gold as a collectible. That means when Ryan sells, he pays up to 28% in capital gains tax, compared to 15 to 20% for stocks. Same gain, bigger tax bill. Just because of what the asset is. Gold's long-term average since 1971? About 7.9% per year. Impressive, until you compare it to what Alex is sitting on. Alex's S&P 500 fund doesn't just go up in price, it compounds. Every company inside that fund, Apple, Microsoft, Amazon, hundreds more, is waking up every morning trying to make money, hiring engineers, launching products, cutting costs, buying back shares. And when they earn profits, some of that flows back to Alex automatically through dividends, which he reinvests, which buys more shares, which earn more dividends. This is the engine Ryan doesn't have. It's called compounding. And Einstein may or may not have called it the eighth wonder of the world, but the math doesn't care who said it. It just works. Here's the difference in practice. Alex has $50,000 in the S&P 500 with dividends reinvested, growing at the historical average of 10.7% per year. After year 5, $82,000. After year 10, $136,000. After year 20, $371,000. Ryan's $50,000 in gold at 7.9% per year. After year 5, $73,000. After year 10, $107,000. After year 20, $233,000. Before taxes, Alex is already ahead by $138,000. But remember Ryan's tax problem. After the 28% collectible tax on his gains, Ryan's real take-home is closer to $166,000. Alex pays 15% long-term capital gains. His after-tax position is around $315,000. Alex, $315,000. Ryan, $166,000. Memes have stopped. Here's where most videos stop. And that's exactly the problem. Because if you tell Ryan his gold was a mistake, he'll point to 2008. And he won't be wrong. When the stock market crashed 37% in 2008, gold went up 25%. Alex's $136,000 at year 10 suddenly looked like $86,000 on paper. Ryan's gold barely flinched. In fact, it climbed. During COVID in 2020, same story. Markets collapsed in March. Gold surged. Ryan slept fine. Alex checked his portfolio and felt sick. This is what gold actually does well. It's not a growth engine, it's a shock absorber. When the financial system itself is breaking, when banks are failing and currencies are shaking, gold holds its value while everything else is on fire. The problem isn't that Ryan bought gold. The problem is that Ryan went all in on the shock absorber and called it a strategy. Imagine you're driving cross-country. Your airbags are critical. You need them. But you wouldn't replace your engine with airbags and call it a car. That's what Ryan did. He replaced his engine with airbags and wondered why he wasn't moving. Gold is the airbag. Stocks are the engine. You need both. You can't confuse one for the other. So who actually won? Over 20 years, dollar for dollar, no leverage, no real estate, just pure returns. Alex wins. It's not close. The compounding engine of stocks beats gold's price appreciation over long periods. Every major study says the same thing. The data is overwhelming. But here's the part that actually matters. Alex had to survive 3 major crashes to get there. 2008, 2020, 2022. 3 times his portfolio dropped 20, 30, even 37% on paper. 3 times he had to sit on his hands and do nothing while everything felt like it was ending. Most people can't do that. Most people see minus 30% and sell. And if Alex had sold in 2008 and moved to gold, he'd have Ryan's number, not his own. The real edge wasn't the S&P 500. It was the discipline to stay in it. And Ryan? He's not broke. He's not a failure. His gold is worth $233,000 before taxes. That's a real gain on $50,000. But he left $82,000 on the table after taxes compared to Alex, and he did it while thinking he was being the careful one. The careful move wasn't gold. The careful move was understanding what gold is for and putting it where it belongs. Not as the whole portfolio, as the 10 to 15% that protects the rest. Ryan needed less airbag and more engine. And Alex needed a little airbag, because 3 crashes in 20 years is a lot of crashes for anyone to sit through alone. Gold is real. Stocks are real. The mistake is picking one and pretending the other doesn't exist. Ryan's $166,000 and Alex's $315,000 weren't determined by which asset was better. They were determined by which role each asset was supposed to play, and whether the guy holding it understood that role before he spent his $50,000. If you watched our last video, you already know how real estate fit into this same equation. And if you're wondering what happens when you combine all three, gold, stocks, and real estate, into one actual portfolio, that's exactly what we're breaking down next. Subscribe. You won't want to miss the math on that one.